Hello everyone, today's video is all about pensions, specifically when it comes to taking your pension. So, since 2015, we've had this so-called pensions freedom in the UK, where retirees can access their retirement benefits a lot more flexibly than they could before 2015, when pretty much the only choice was to exchange your pension pot for an annuity. So you'd go to an insurance company and you'd say, right, I have a pot of X, what can you give me as a guaranteed annuity for life? And that's the way that most people did it. Since 2015, the government have brought in choices, basically where you can leave your pension pot invested and then just draw down an income from it to see you through retirement. Now, that is a lot more riskier from a financial point of view, in terms of you can take out too much too soon and blow the pot years before you will pass away. So, big problems for many people now that we've had a few years at this. So the government said at the start people should take advice, but tens and tens of thousands of people didn't take any financial advice, and a lot of people were left worse off because of that. So what is coming in from the 1st of February is a new directive from the government to the big pension firms to say, look, you have to at least offer certain investment pathways to retirees at the point of them taking their pension. So, they may not be taking advice, but at least you've got to make this easier for them by saying to them, look, depending on what your plans are, we will put you into one of these 4 default pathways. Now, the pathways are, so the first one is for those people who have no plans to touch their money for the first 5 years in retirement. The second pathway is for those who intend to start taking an income in those 5 years. The third pathway is for those who expect to take out all their money in the 5 years. And then the fourth investment pathway is for those who plan to use their drawdown fund to buy an annuity within 5 years. So go down the sort of the more historical, traditional route. So they're the 4 types of investment strategies that the big pension funds will offer to individuals. So as an example, what would that mean? So let's say you start with the first one. So that is those people who've got no plans to touch their money, their pension pot, for the first 5 years. So what they will do, that the pension fund will put them largely in a balanced investment fund with exposure to some equities, so some further growth, but it's still going to be have some caution in that investment strategy. For the second one, for those who begin to take an income within the first 5 years, they might be offered a more balanced investment product. We're more cautious, so less exposure to the stock market. On the third investment pathway, so this is the one where people expect to just take the lot out of their pension fund within 5 years. That investment will mostly be in cash, so the pension pot that would, liquidate whatever investments they had and pretty much get all of that in cash. And for those on the fourth investment pathway, which is people who are expecting to swap their pot for an annuity, like people used to do, or like everyone pretty much did before 2015, well, the investment pathway for those individuals will be largely in government gilts, because the performance of the UK government bonds is closely linked to annuity rates. So they're the types of investments that you would be put into or offered by the insurance companies. Now, there's no obligation to take them up on any of those. You can still do your own thing, but in the absence of the fact that a lot of people are not taking financial advice and blowing the money too quick, the government has to be seen to be doing something, and what they are doing is saying to the big providers, at least make it clear to the various individuals, based on a conversation of what their plans are, you should go into one of these 4 default funds. but you don't have to. So it's still your choice. But I would say everyone contemplating taking their benefits at retirement needs to speak to a financial advisor. So yes, you have these 4 investment pathways, which is a good start. I mean, it's sensible. It's kind of like something for the masses, and it's not bespoke, but at least it's better than the pension providers saying nothing to you and just letting you crack on free will, which you still can do. You don't have to take their advice, but at least they're putting things in place to help the issue. And the issue is still, remember, the issue will still be there in terms of affordability. How much should you take out? So this is, remember, what's being said, and the new directive from the government is advising the types of assets that you should be invested in at various stages in retirement and what your plans are for those first 5 years in retirement. Doesn't tell you exactly how much to take out. Now that is even more complex. How much should you take out each year? How much to leave in? What about the tax-free lump sum that you're entitled to? How much of that can you take out? Can you take the whole lot out up front? So that even with these useful investment pathways brought in from the government, from the mandated from the government to the various pension providers, still a lot of unanswered questions which you would need advice on. Your pension provider isn't going to give you that advice. They're not going to say, oh, I think you should take no more than 3% a year or what of the pot or whatever. That's where you need specialist advice. So I do recommend that you speak to a financial advisor. So that's just an overview of what's changing in the pension world, specifically these new investment pathways for people who are taking their retirement benefits. If you like this video, do subscribe right there, and I will see you soon.